So Target has announced that they've had 10 consecutive quarters of falling sales, and that's a big deal. Now, revenue and profit declines are a big deal, but cash flow may be even a bigger deal because you have to have cash inflows to operate your business. So we may not be able to do anything immediately about the revenue and the net income, but we can do something about the cash flows. And you can think about it this way. Let's say you start a business in January 1st, and you put in $50,000, and you get to March 31st, you've been profitable, but you only have $10,000 in your account. The question is, where did your cash go? Well, where it probably went is it's tied up in inventory and accounts receivable, which are typically the two biggest balances on the current assets on the balance sheet. So it's not in cash. It didn't go away. It's tied up in inventory you bought and receivables you haven't been paid. So the solution to this is to use two turnover ratios and improve those ratios. So the first is inventory turnover ratio, which is cost of sales divided by average inventory. So let's say you have $1 million cost of sales, $100,000 average inventory. The ratio is 10 or 10 times. In other words, you are turning over your inventory completely 10 times a year, 1 million divided by 100,000. The idea is you want to sell more, increase the numerator, cost of sales. You want to drive down the denominator, inventory. So you are selling more and more with less and less inventory, and the ratio goes up and you collect cash faster. In a similar way, accounts receivable and turnover ratio is net credit sales, those sales that were on credit, so you have been paid immediately, divided by average accounts receivable. And again, the idea is numerator, you want to increase net credit sales, we want to sell more. Denominator, accounts receivable, we would love to have a lot more net credit sales and a lot less accounts receivable so that the ratio gets bigger. So both with inventory turnover and with accounts receivable turnover, a bigger ratio, a bigger number means you're turning over faster, you're collecting cash faster, and you're in better shape from a cash flow perspective.